In this channel favorite series, we continue to build a total return TFSA from 0 to 100K. Last month, we added our first American stock, and this month, we are going to add more as we focus on the biggest economy in the world and why you may want some US exposure in your portfolio. Hold on to your seatbelts, folks. This is going to be a good one. This challenge is officially 1 year old. Happy birthday, TFSA challenge. We currently have invested $6,500 into the challenge. Each month, we add $500 as well as any donations received on the channel. In fact, you guys have added $337 so far with those supers. A huge thank you for your support. The United States has the biggest economy in the world, and as a result, they also have the biggest stock market. The US roughly has $40 trillion in market cap compared to Canada and our measly $3 trillion. So that makes the US stock market over 13 times larger than ours.
Candace, tell them about pension funds.
Hazel Nutterscotch does bring up an excellent point. In the news lately, pension funds are concerned that the government will force them to invest more in Canada. Why is that a big deal? The US stock market has historically outperformed the Canadian market due to the presence of high growth sectors like technology and healthcare. Limiting exposure to US stocks might result in lower overall returns for pension funds. Let's look at a little bit of data. The TSX year to date is coming in, well, at 4.38%. The S&P 500 year to date, well, it's a lot higher, 15.13%. The data more than suggests that it is a good idea to have some US exposure in our portfolios. So how can we go about doing that? Some of the stocks that we already invest in will give you some exposure to the US market. Take Brookfield Asset Management, or BAM.A. The US is BAM's prime focus because of, well, the points we made earlier. A lot of the ETFs we like, such as Vanguard's VFV, they invest in a basket of American stocks, so it is easy to get some exposure. Some Canadians want to invest in the US, but they don't want to deal with, all the hassles of currency conversion. So for those folks, a certificate of depository receipt, or a CDR, may be exactly what you are looking for. CIBC offers these, and how they work is that they will hold a certain amount of NVIDIA and then offer CDRs, which act as NVIDIA shares. You still enjoy the growth and dividends just like holding NVIDIA on the US market. However, you do not have to worry about the currency side of things, as CIBC takes care of that hassle for you. CDRs are becoming more and more popular. At the time of recording, there are a total of 55 different CDRs that include Uber, Microsoft, Tesla, Bank of America, just to name a few. Of course, you can also invest directly into the US market. You can buy and hold US stocks in your Canadian account, but you will have to deal with currency conversion and currency exchange fees, which can eat away at those American profits. A better way is to have a USD account where you can hold a US balance and then buy and sell in USD without any currency issues. Most brokers will charge you a currency conversion fee when you move money into the USD account from a CAD source. There are ways or methods to move Canadian money over to USD money without a fee, and that involves a little something called the Norbert Gambit. This is a method made popular by Canadian in a t-shirt, as he has a great video on how to do it with Questrade. You can also do it with a national bank direct brokerage. So what is this Norbert Gambit? In a nutshell, it is a method where you buy shares of a stock that exists in both the Canadian market and the US market. Popular choice for this is DLR.TO and its US counterpart DLR.U. You would buy an amount of DLR.TO in your Canadian account. Once this is settled, you then call the broker and request that they move the DLR from your Canadian account over to your US one. Once this final trade settles, you then sell the DLR.U for US cash in your USD TFSA. No currency conversion fee. Speaking of free, a sub to the channel would be, priceless. Let's get into the challenge portfolio. We will start with the stocks that we have not added to in this cycle. So we have Alimentation Couche-Tard with a 0.21% total return. BAM's coming in at 8.88%. Bird Construction, holy banana bread, 42.85%. That's really good. Scotiabank, total return of 5.65%. CNR, 8.43%. Drax Group is coming in at negative 2.39%. Canoe, CNQ coming in at 9.78%. Fortis just a little bit to the negative with a negative 0.04%. HXQ coming in at 12.20%. Cisco Royalties negative 3.44%. And QQCC coming in at 7.29%. And we also had that US AI ETF that we added last time. AIQ, they came in at 3.61%. Let's switch gears and look at the stocks we have added to this time around. Up first, we have Bell Canada, and we added another share to bring our total up to 10. They currently sit at a 6.80% stake in our portfolio. They got an adjusted cost base, $47.82. Their current price comes in at $44.31. So far, we have received $5.99 in dividends from them. Return on investment, not looking great, negative 7.34%. Total return after we factor in the dividends, negative 6.09%. I am still long-term bullish on Bell, and I will continue buying the dip for sure. Next, we have the Purpose Bitcoin Yield ETF, and we added another 4 shares to bring our total up to 46. They have a 4.20% stake in our portfolio, adjusted cost base $5.34. Their current price at the time of recording, $5.95. We did receive another $2.21 in dividends. That brings our total up to $10.20. Their return on investment, that comes in at 11.42%, and we have a total return of 15.58%. Bitcoin struggled in June, and the lower return on this one definitely reflects that. We added 2 shares to Canadian Natural Resources, bringing our total up to 8. We currently have a 5.98% stake, and their adjusted cost base is sitting at $44.09, while their current price, $48.73. We have so far received $6.95 in dividends. We have a return on investment of 10.52%. Total return 12.49%. CNQ did a 2-to-1 stock split in the month, so technically I only bought 1, but it split in half into 2, so what can you say? Up next, we have Decisive Dividend Corporation. I added 2 more shares for a total of 40. That's a 4.46% stake in that one. Their adjusted cost base comes in at $8.45, and their current price at time of recording, $7.26. We did receive another $1.71 in dividends, taking that total up to $8.58. They are still well in the negative with a return on investment of negative 14.08%. Total return, negative 11.54%. Still not a great month, but that can be said for the overall market. Our next stock is Diversified Dividend Corporation, and I added 10 shares, taking this up to 50 in total. Their current stake comes in at 2.08%, adjusted cost base of $2.80, while their current price, $2.71. We did receive an additional $1.04 in dividends, taking that total up to $2.81. Return on investment, negative 3.21%. Total return after we factor in the dividends, negative 1.21%. So I was able to average this one down just a wee bit. So that's not too shabby. I did add another share to Hammond Manufacturing, taking us up to 26 in total for a 3.87% stake in my portfolio. That adjusted cost base, $8.91. Current price, $9.70. We're still sitting at a total of 81 cents in dividends. Their return on investment, this is low for Hammond, 8.87%. Total return of 9.22%. I still have faith in the Hammond stocks, as we have been experiencing a correction. This is a long-term hold for sure. We added 1 more share of Pizza for a total of 16 shares and a 3.21% stake in my portfolio. Their adjusted cost base coming in at $13.93, current price $13.09. We did receive another $1.16 in dividends for a total of $3.41. That return on investment, negative 6.03%, total return of negative 4.50%. I know I sound like a broken record, but I'm still loving this stock, and I do expect to turn around once we get deeper into rate cut territory. Up next is Ryokan, and we added 2 more shares for a total of 15 and a 3.87% stake in my portfolio. Adjusted cost base $17.67, current price $16.81. We did receive another $1.20 in dividends, taking that dividend total up to $4.51. Ryokan has slipped into the negative with a ROI of negative 4.87, total return negative 3.17. I am definitely still bullish on REITs, and the next one kind of proves it. We got our first new entry and the only Canadian entry, though they do hold some US REITs in their basket. In fact, their basket is 50% US REITs. We have the Hamilton REITs Yield ETF, and I opened an initial position with 2 shares for a very small 0.50% stake in my portfolio. Adjusted cost base $16.08. Current price at the time of recording $16.20. No dividends yet, but we do have an ROI and a total return of 0.75%. This is a brand new ETF that launched about a week ago. I have high expectations on some solid returns as the real estate sector moves into recovery. Up next is Sir Royalty, and we added 1 more share for a total of 25. That's a 4.91% stake in my portfolio. Their adjusted cost base, $15.59, and yikes, their price, $12.80. We did receive another $2.38 in dividends, bringing that total up to $15.49. Their return on investment, oh dear, negative 17.90%. Factor in all those dividends, and we get a total return of negative 13.92%. This one is hard to watch, but patience will be rewarding with this one for sure. Next, we have Timber Creek Financial. I added 3 more shares for a total of 21. That's a 2.10% stake in my portfolio. Their adjusted cost base, $7.36. Current price, $7.16. Their dividends, we did receive another $1.04, so that's a total of $3.51. That return on investment coming in at negative 2.72%. Total return after we factor in the dividends, negative 0.45%. This here is another high conviction real estate stock for sure. Next, we have the iShares S&P TSX Capped Energy Index. I added 5 more shares for a total of 15. That's a 4.19% stake in my portfolio. Their adjusted cost base coming in at $18.55. Their current price, $18.20. We did get our first dividends for these guys, $2.70. That return on investment, negative 1.89%. Add in the dividends, total return negative 0.92%. It is really hard to go wrong with an energy ETF. We did add another 2 new stocks to the USD TFSA for the challenge. First, we added Friedman Industries, a US steel manufacturer. We opened our position with 5 shares. That's a 1.59% stake in my portfolio. Their adjusted cost base, $23.93. Current price at time of recording, $20.66. We have not received any dividends for them, and we're sitting at a return on investment / total return of negative 13.66%. I do want to point out that all of the prices I'm using for my US stocks have already been converted to Canadian dollars. It simply makes the challenge math much easier. With Friedman, I was definitely disappointed at the big drop after buying the stock, but I do like their fundamentals, and I stand by the selection. Let's see what happens next. The next new US stock is Liberty Energy Inc., and I opened a position with 3 shares. These guys make pressure pumpers for fracking, and there is a huge demand for their services as the US ramps up oil production. That puts them at a 1.32% stake in the portfolio. Their adjusted cost base, $28.28. Current price, it did go up a little bit, $28.58. So we do have a return on investment and a total return of 1.06%. This one has some pretty impressive growth potential, and I'm definitely excited about that. Next month, we are ready for, well, that summer rebalance. So there will be a few changes for sure. Will Sir Royalty survive? You'll have to tune in to find out. Now, let's take a quick look at the overall portfolio. June has been a dreadful month on the market. Lots of great buying opportunities, but not great on those total return figures. In fact, the challenge TFSA is sitting at a total return of 0.47%. Granted, I pulled the data on a pretty red day, so it is skewed lower as a result. We'll get redemption next month, folks. Let's take a quick look at the portfolio's diversification with, of course, that Blossom app, the link down below if you have yet to try Blossom. I'm liking what's happening. Financials has come back down to 25.5%, industrial sitting at 19.4%, consumer cyclical climbing up to 17.5%, energy 12.3%, communications 8.2%, technology 5.4%, real estate 4.1%, utilities 3.6%, materials 2.5%, consumer staples 0.8%, and bringing up the rear, we do have healthcare at 0.7%. Next month, stock buys will absolutely be taking these numbers into consideration. It is time to look at the toad and the goat of the portfolio for the last month. The infamous Toad Award for our worst performer of the month is going once again to Sir Royalty with a negative 13.92% total return. Friedman was a runner-up with a return of negative 13.66%. And now for the goat. We have a brand new goat. Bird Construction pulled off a holy banana bread of a month with a 42.85% total return. Runner-up is, well, last month's goat with BTCY coming in at 15.58%. So that is our update for the month. We will be back here again next month to do it. Well, we'll do it all over again. If you are interested in any of the stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money. Wait for it. On the table. Let's continue that learning journey. Check out this video on international ETFs. Thank you for watching, and I will see you in the next video.